Hi, I'm Vince Molinari, and welcome to FinTech TV's The ETF Rundown. We're broadcasting from the iconic New York Stock Exchange, and I'd like to welcome Scott Willis. Scott is the co-portfolio manager of Grizzle Growth Fund. Prior to running Grizzle, Scott was a Wall Street analyst at Credit Suisse and TD Bank, on both the buy side and the sell side, publishing research and investing in the energy, industrials, technology, and cannabis industries. Scott, welcome to the show.
Thanks, Vince, for having me. Excited to talk about GRZZ.
Yeah, I'm thrilled. I want to hear all about it. Tell us a little bit about the evolution, the starting of things, and why you launched.
Sure. So the strategy that we use in the Grizzle Growth Fund, we've been doing that for about half a decade. And what happened is we were doing this privately for ourselves, and then we looked at what was available in the market. We just saw that for other investors, there was a gap there where you either had funds, some of the big names you know that invest in innovation, where they don't really care about the price they're paying. They're just worried about the growth. Or conversely, you have some bigger funds that will kind of buy all the innovation funds. And then what you end up with is a NASDAQ vehicle that charges you 10 times the fee. So we just thought there was a gap in the market, and it was something we'd already been using with success. So let's make it public for everyone.
I like that. You kind of shared a bit of the secret sauce.
Exactly.
Way to democratize. It was a little piece that I read, kind of the view of Grizzle, where I want to paraphrase it, and if I get it wrong, kind of innovation is never really in a bear market or investing in innovation. Talk to me a little bit about that.
Yeah, so I think the investment industry loves to compare growth versus value, which is outperforming, which is underperforming. But from our point of view, if you do growth investing right, there's not a bear market. The risk with growth investing is, the multiple you pay often gets very inflated at certain times in the cycle. So the strategy we use, which is a very strong focus on valuation, not just the growth outlook, helps you avoid those periods. And as long as you do, when multiples crash like they have in the last 9 months, if you can avoid that, underlying results of growth companies are better than value companies. It's not a mature industry. They're growing revenue very quickly and oftentimes cash flow very quickly. So that's why, as long as you avoid those periods of a run up in valuation, we think you can do very well through all markets and growth.
And you just mentioned talking about the retrenchment in valuation a bit today. So I would imagine that is pretty good timing for you.
Exactly. Lots of opportunities now compared to even 9 months ago. And we look at valuation very closely. We weight that equally with kind of the growth outlook for things. So still a lot of things up in the air with the market right now, but we're seeing much better values than we did 6-9 months ago.
Great position to be in as the investor.
Exactly.
Well, another one, DARP, caught my eye. Tell us all about DARP and what's the strategy behind that.
Yeah, so DARP stands for disruption at a reasonable price, not any price. And that comes back to what I said, where when we looked at the market as a growth investor, if you're going to buy ETFs, you had this opportunity where there was some big funds that were talking about how important innovation is. But if you looked at the values they were paying for these companies, some of them were pretty crazy. We're getting into 100 times price of sales. And it's very hard to make money when you buy something for that type of valuation. You need a company to grow very fast for 10 years, maybe more. So we've went back and did a study over the last 20 years of investing in technology, and we found this DARP, disruption at a reasonable price, which is where you pay below average valuation on revenue, and then you look for companies that have very high margins, and that historically has done much better than paying any price for disruption or even bottom feeding, as Warren Buffett would do. Those have all underperformed this strategy.
So kind of interesting, if I look at the elevation part of the higher value, I can kind of get my head around that pretty quickly from a performance standpoint, but really surprising when you look at the bottom fishing and saying, the better performance is this intersection that you just described.
Yeah, pay a little bit more.
Right? Pay a little bit more, which just seems kind of counterintuitive a bit, but I suspect you have to be quite disciplined in the approach.
Yeah, what we found is I think the reason buying the cheapest stocks doesn't work is because the market is good at figuring out what companies are struggling. So there's a reason that they're so cheap. And that's why that cigarette butt investing, that Warren Buffett has been famous for, doesn't work so well in technology because of how quickly the industry moves.
So when we talk about, kind of the historical perspective, would we equate this to backtesting a bit on DARP, or how do you relate that to its performance going forward?
Yeah, so what we did is we looked at the security, the entire security, the entire technology industry, and we looked at, you can buy 4 different buckets. There's the average, there's pay any price for growth, there's the pay the cheapest 10% price to sales, and then what DARP is you pay below the average, but not the cheapest. And then you also look and make sure that margins are very high. So the underlying unit economics of the company are very strong. And so we found 2 very interesting facts. There's less drawdowns in bear markets, so DARP goes down less. And then also, most importantly, in rebounds, it goes up quicker than some of these other strategies. And 2020, 2021 was interesting because those innovation at any price funds, they outperformed for a period of time, say 3 months, but now they've drawn down much more. And we think this whole cycle is going to repeat after looking at 20 years. When we get the rebound eventually, DARP paying, not too expensive, but great unit economics will bounce back faster than these other strategies.
It almost sounds like a much more committed capital when I look at a DARP strategy versus maybe chasing some of the stock du jour or sector du jour that has a tendency to have drawdowns much quicker.
That's a very astute observation. So the way we look at it is long-term. So we'll take a 10-year view on a company, and then we look at the performance. Stocks obviously don't move in a straight line to where you think they're going to go. There's certain years where they do very, very well, certain years where they retrace a bit. So by having that 10-year view, you can instead of what Wall Street typically does is, my 1-year price target, I'm going to ratchet that every year. Because we have the long-term view, we can look if a stock has maybe run too much in a 1-year period, take off some of our weighting, vice versa. If it's fallen a lot, we still believe in it, you can move the weighting. So that's where the valuation meets portfolio management.
I want to talk to you about one last component, which I think is a key differentiator when we talk about the global energy market, and you have a position around renewables and things of that nature, where to allocate. Can you share that with us?
Yeah, so that's a big theme for us. We call it energy transition. So this is unique among growth funds because what they've done is they say if you look at energy, it's renewables only. So it's going to be an electric vehicle or a solar panel or a windmill. But they're forgetting that to enable all of that, there's a lot of materials that go into that. And that's what we call the supply chain for renewables. So there's a huge opportunity there where lithium providers, copper, all these different materials, all these renewables, obviously they have less emissions than dirty fossil fuels, but they require much more materials. So that's the trade-off. So we think there's a huge opportunity also in natural gas to enable that move from fossil fuels to renewables. You can't just, as we've seen with the ongoing energy shortages, you can't just drop fossil fuels and wake up in a utopia of renewables.
So you got to go a lot deeper in the supply chain to the source to kind of manage that transition through the process.
Yeah, you need help to get to building those things, and that's where the supply chain comes in. We think natural gas is the easiest way for us to meet our emissions targets globally, and then also you have the miners that are providing all the materials we need to build those electric cars, build those windmills.
Terrific. Well, Scott, thank you so much for joining today and sharing a lot of the background and what I think is the kind of cutting edge components around DARP.
Thanks very much, Vince, for having me.
It's a pleasure.